Have you ever wondered how you can unlock new opportunities and knowledge that can truly change your journey as an African immigrant? Then, you're in the right place. Welcome to the AIM Expert series, where we bring you insightful sessions, packed with practical strategies from top experts on topics that matter most to you. So, if you're looking to grow your career or understand the US system, then grab a chair and don't go anywhere. Now, let's get started on today's session.
All right, so this is the topic for the day. Building wealth beyond your paycheck, okay? So just a little bit about myself. My name is Melat Sissay. I am been in the financial services for going on 3 years now. So originally I was born in Ethiopia. So for you guys who didn't know, I'm Ethiopian. I was born there, and then I moved from Ethiopia to Sweden when I was 7. And then so majority of my life, I would say I lived in Sweden. And I got here to the US about 7 years ago, 8 years ago now. I got a great opportunity, blessing, scholarship to play basketball, Liberty University. I don't know if you guys know, it's a Christian university in Virginia. And then that's where I met my partner, and he is from Atlanta, Georgia. So that's how I ended up here. So before I was in the financial services, I was in HR. So I always loved to help people and just be able to, share information and stuff like that. So the position I had when I was in the HR field was actually great. I was an opportunity for me. Most of the time, when you work in HR, you don't get to see the people, only on the phone and stuff like that. But the area that I was working in, it was very much hands-on. So I got to see people, hear people all the time. And I really liked that. So I feel like that was my calling. And so moving into the financial services, my in that field. So being around him and listening to him, how he'd been helping people and just sharing knowledge. And I was like, I'd like to do that. And I like to be my own boss with that. So I said that would be a great opportunity. I get to do what I love, which is meeting people, talking to people, and then also share information that a lot of people don't know too much about. And so that's how I got into this business. And so far, it's so good. I really love it. I truly feel like this is a calling of mine, so very passionate about it. So that's a little bit about me. So let's get to today. I would love for it to be very interactive. So, if you guys have any questions, and I might have, ask you guys a couple questions while I do the presentation, then, please interact and see like you guys are with me. And so I know that, everything I'm saying is good. And so yeah, let's go ahead and get started. So let me see if allow me. Here we go. So building wealth beyond the paycheck. So, I don't know if you guys probably heard, the saying, it's not about how much you make. It's really about how much you get to keep, right? Because there are a lot of people, if you think about it, there are a lot of people who wish that, oh, if I only, earn this amount of money, or if I only, won the lottery tomorrow, I would have fixed this, I would have done that, I would have done this, all these things, right? But at the end of the day, if you don't know how to use the money that you already have, the chances are you're going to treat the money that you might get and then increasing the same way because you don't have that financial foundation, right? And so when it comes to the financial foundation, especially in the US, it's like it's different. Different countries have different rules and regulations. And then if you know, and I'm an athlete, like I said, so I like to say it, the analogy, if you know how to play, if you understand the rules of the game, you know how to play by the rules of the game, right? And then more likely you would win. But if you don't even know that you're playing a game, you didn't even know you were in it, then you're more likely losing it. And sometimes you're losing without even knowing, right? So this is like you can see as like a financial game that some people don't even know they're playing because they just go on by their day living, do the things, the same motion, right? And so for me, it's like understanding the rules, understanding what money really is, understanding how can I maximize what I have right now and be more effective and efficient with it. So when I increase my income at some point in time, I know exactly what I'm going to do that's going to help me to accelerate it even more, right? So that's the goal right here.
What I leave that place.
Oh, So you gotta mute. Excuse me. So the
Yeah,
hidden
sorry
truth,
about that.
no, you're all good. The hidden truth about money, right? So every month, a lot of people makes a lot of money, but then at the end, sometimes before we even get the money, that thing is out the window because we got to pay all these bills. We have, some people have debt. So you might have an income of, like, I had a client say he got an income, I think 80,000, and his wife have somewhere between like 75, which is, pretty good. That's pretty high, right? But he said, I don't feel like I'm making all that because majority of my money is going out the window before I even get it because I got to pay all these bills. I have debt that I got to pay for. So, it's just a number at the end of the day. When you don't get to keep it, you work really hard, but you don't get to keep majority of the money because it's just going right out, right? So that's the whole purpose. And once again, here, it's not about how much you make, it's about how much you get to keep. Like, I want to hone into that because another example is like we have, there are a bunch of athletes, people who, win money, and people who make fortune, like bunch of money, right? And they don't have the right financial foundation, the financial knowledge. When their career stop, you see there are a whole bunch of bankruptcies they're filing, right? They've been using and burning all that money because at the time, like, okay, money's coming in. I'm gonna do this, I'm gonna do that, I'm gonna enjoy myself. And then next thing you know, life happens and then all that income just stops. And what do you do now? You haven't set any type of foundation, anything for yourself, and now you're finding yourself in a hole. So building a good foundation is so important. Okay, so with that, now let's talk about some money. Let's talk about the money, right? So are there any holes in your money bucket? I like to use a bucket as an analogy to describe where we position our money. So if we have different buckets. We have savings, we have retirement accounts, we have maybe money inside of a market, whatever it might be, right? Different buckets. And the whole goal of the bucket is to fill it up as much as possible. So it could be, we could use it how much we want to, and just thought of being financially free, right? But if there are some holes in those buckets where you consistently, like, you pour into it, but you're losing it, and sometimes unwillingly and unnecessarily, that you don't even was aware of it. So our goal is to identify, what is my bucket? What type of bucket do I have? And are there any holes in my bucket? And if they are, how can I, fix those holes so I can actually maximize it and fill up my bucket? Okay. And so with that, inflation and taxes can create big holes in your bucket, right? That's one of the things. So when it comes to inflation, one thing we got to know is that inflation is about 2.93% currently. And so every time you put your money somewhere, it could be your savings, it could be high yield savings account, it could be for retirement, wherever it is, when you don't get a return on your money, which is less than 3%. I mean, when you don't get a return on your money at least 3%, you are losing the value of your dollars. So to give you an example, if you have like $1 million right now in your savings account, and in 20 years from now, and inflation didn't change, didn't even go up. In a traditional savings account where we barely earn any interest, right? 3%, that's kind of a lot. And if inflation stayed the same, in 20 years from now, that $1 million will only be worth $500,000. It still shows a million, but it will only be worth $500,000, right? And the reason why is because of inflation. Your money is losing value every single year. It's not competing with inflation is. So with that being said, knowing this is a rule, right? This is a rule, like, okay, excuse me. Now I know how inflation works. Now I know, okay, if I'm putting my money in a savings account and I'm saving for something in the future, or I'm saving for a down payment for a house, or I'm saving for, a car, or I'm saving for college for my kids, or retirement, you should know now that, okay, I should not probably be saving somewhere where it's earning 0.1 interest, right? Because that's not helping me. It's going backwards, right? So, and one thing you want to think about when it comes to money is also, money is like energy. It's either moving forward or it's moving backward. So it could be moving forward for you if you know where to position it to accumulate it, to accelerate it. But it can move in backwards when you don't know, you're just placing it because that's what you've been told to do, right? So in this case, if you're not completing with inflation, it's going downhill, right? And then of course, taxes. We know, well, we're gonna get deeper into about talking about taxes because taxes is a lot. And knowing, understanding when it comes to taxes. I'm not a CPA, so don't take me for that. But understanding like the different tax structures will allow you to know where to position your money, whether that be for long-term goals, midterm goals, short-term goals, whatever it is. Now you understand because you know the rules and you know how to play by the rules. Okay, we good so far? Anybody have any questions? Good, we good? Let me see. Make sure. Okay, perfect. All right, so let's move into the next slide. So the first bucket we're going to talk about is the tax-free bucket. Okay, so the tax-free bucket, oh, no, it is not. Let me see, how did it jump over there? Okay, here we go. There are 3 money buckets. This is what, you guys have been hearing about, talking. I'm going to be talking about the 3 money buckets. This is it right here. You have the taxable bucket, you got a tax deferred bucket, and then you have your tax-free bucket, okay? And, I'm sure you guys maybe probably heard what they say, diversifying your portfolio is really good, right? But not a lot of people talk about how you need to diversify your tax structure. And so what does that mean? You can diversify your portfolio within the same tax bucket, but if you're not diversifying in the different tax buckets, then you're not really diversifying after all. And I'm going to go deeper into what that means, what all these, different tax buckets, what they mean. So to begin with, the taxable bucket. So this is money that you earn, this is your savings. Every time you get paid from your job, you're going to be taxed. Every time, you have your money inside of a savings or in the market and you earn any type of interest, you're going to be taxed. So this is money you're going to be taxed all the time. Doesn't necessarily mean it's bad or whatnot, but you're going to be taxed, right? So now you have an idea like, okay, this might not be where I should position my money if I'm looking to save for, a long time, a midterm goal that I have, because I'm consistently being taxed and inflation and all that good stuff. So I might have to position it elsewhere, right? So this is where the money being taxed all the time. And then we have the rule of 72. Does anybody here know what the rule of 72 is? Put 1 in the chat if you know what the rule of 72 is. Okay, nobody, okay, I was waiting, nobody knows. Okay, great, I love that. So now I get to heard of it. Okay, so I get to explain it to you all. Okay, perfect. So the rule of 72, I know it's a lot of numbers going on here. Don't freak out, I'm explaining, it's gonna make all sense, okay? So the rule of 72 is basically a calculation they put together to calculate how long it's going to take for our money to double, right? No matter where you position it. So for this example here, we have a person that is age 40 right here. And then we say that person is putting in $1,000. And we're going to look into 3 buckets right here where they position their money, okay? So that person putting 1,000, age 40. So what we take when it comes to Rule 72 to calculate how long it's going to take for them to double their money is you take the number 72 divided by the interest is going to earn, and then you get the year. So for this $1,000 to be $2,000 is going to actually take 24 years. And 3% interest, that's pretty good if you ask me, right? Because traditional banks, we only earn like 0.1%, right? So, but who got 24 years to wait for that money to double? Right? So nobody got time for that. But this still gives you an idea. Okay, so this is not a traditional bank account. This is, CDs, high yield savings account where you earn 3%. So you can imagine how long it's going to take if you put it on your regular savings account forever, right? And then let's see how long it takes if you put it inside of a stock market. So about, let's just say roughly you earn 18% interest. You take 72, divide by 18, about 4 years, which is not as bad, right? It's not too bad. However, we know how the market works, right? The rules of the game of the market is that you could go up, great, and then you could go right down the next day, right? So you can earn a whole bunch of money, and then you can get wiped out if you're not careful, what you're doing, right? And so there is no security in this, right? So it might take 4 years, it might actually take maybe 6 years, or it might take 2 years, right? Because even if you earn okay, the next day maybe you earn $500, and then the day after that, now you're back at $100. Now you gotta go back again, right? It could go up and down. So just roughly, it might take 4 years, okay? And then we have the equity index. So this is like the cash value policy. This is um, um, policies like index universal life policies or policies where you have market protection. So you have upside gain, but then you also have a downside protection. So you're not really having to compete with the market. So if the market goes up, you get to participate in market gains. If the market goes down, you don't have to worry about losing any of your funds, okay? So when you put your money inside of here, it takes 6 years. It's not as attractive as 4 years. However, you have here the security, knowing that, okay, regardless, I'm at least, not losing in the process of trying to accumulate my money. So in a given year, if the market is not doing good, that's fine, because I know that I can, pick back up the following year, and I get to keep it rolling. So that's what the rule of 72. So they give you an idea like, okay, if I position my money here and I'm trying to accumulate, I'm trying to grow it, whatever reason might be, this give you an idea. Where should I position my money? What is it for? And how can I maximize it as best as possible? Okay, so that's what the rule 72 is. So I hope you guys, if you need to take screenshots, take some notes, definitely will recommend that. Okay. All right. So now let's move into the tax deferred bucket. So the taxable bucket, that's what you're getting taxed all the time, right? The tax deferred bucket, this is your traditional like retirement planning when it comes to in the US, right? Your 401ks, 403bs, TSPs, all these retirement, most of the time is retirement plans where it's government structured. So where you don't have to pay taxes right now, but when you need it later on, that's when you're going to be taxed. So with that, I have a question for you all. Do you guys think, I don't know how much you guys know about the US history and taxes and all, but just from where you at, do you think taxes are going to be higher, lower, or stay the same in the future? Higher? Okay. Anybody else higher? Higher, higher. Everybody say higher. I agree. Based on the learning, but based on the history, based on what people would be telling me, and speaking to seasoned people that lived here their whole life, they just been seeing that thing increasing, right? So if we know that it is higher, or we think it's going to be higher, right? We're hoping it's not, but we think it's going to be higher. Would you rather now pay taxes now, so you don't have to worry about pay taxes later when it is potentially be higher? Or would you rather still wait till later, and then you might be on a higher tax bracket? So would you rather be paying now or later? Let me see. What you guys think? Pay now? Right? That would make sense, right? Like, okay, let me just go ahead and pay my taxes now, because now I know everything else, whatever I'm growing later on, that's gonna be mine. Because I have clients where they say like, yeah, I have $500,000, my retirement account, my 401k, been doing, great and all that good stuff. So I'm good. And I was like, okay, that's awesome. $500,000, that's good. That's amazing. But how much is that $500? I mean, $500,000 is actually yours, right? That's the question. A lot of people are like, what do you mean? Yeah, because you have to share that money with Uncle Sam. This is Uncle Sam right now, by the way. This is Uncle Sam. So when you need the money the most, which is for retirement, right? That's when you're trying to relax. You're not trying to think about paying somebody and all that. You've been working all super hard all your life just so that when you finally retired and trying to access your money, Uncle Sam was going to take his cut first. You don't get to take your cut first. Uncle Sam will get to. So if, the government right now, we already know, I'm not even going to say his name, but, craziness can happen. And they can say like, oh, the country is going downhill. We need to tax you on 40%. What you going to say? You can't say nothing. You can't sue them. There's nothing you could do. They could say 50%. We need 50% of that money. There is nothing you could do. Whether tax will be higher or lower, they can make changes however they want to because this is government funded. Government structured policies, right? And don't get me wrong, this is not bad. Once again, what I'm teaching here is for you to understand how these things work so you know how to play by the rules of the game, right? Because if you have a company where they're going to give you a match, right? Certain companies say, okay, we're gonna give you a match. So from your paycheck, you put in 2%, and then or you put in 5%, and the company put 3%, or whatever case might be. That's great because at least they're helping you growing that money, right? So when they come back and Uncle Sam's trying to take their cut, that they at least got a portion of it, right? They help you build that money. But if you within a company where they don't help you at all, that's kind of tough, right? But one thing about that is also when you think about it, when companies matches, so this is something I definitely want you to pay attention to. If you do 5%, become 5% out of your check goes into your retirement account. Let's just say 401k for example. And then a company matches, but they only do 2%. Then I always tell my clients, do whatever they do. And then the rest of the money that you put towards that policy, diversify it and put it somewhere else, right? Because at the end of the day, that 2% that they put in for you is not because they like you. I'm sorry to tell you that. It's not because like, oh, this person is so good, let me be so nice and give them. No, it is a client retention type of thing, obviously, but that's just a tax write-off for them. Okay, so they can just write it off. So if they could do 5% just like you do, if you do 5%, they could do 5%. So they can just write it off, but they don't believe in it enough to do 5%, just like you're doing. So why should you put all your hard-earned money in there, trying to put so much money in there, and then for you to, half of it or the 1/3 of it will be gone or given to them back just because you worked so hard to build that thing, right? I'm sure you guys probably heard some of y'all, the saying is max out your 401k, max out your TSPs, max out this and that. But why? Why are we maxing out? And what type of benefit does it do for us, right? And how can I diversify? Should I max it out? Does it make sense? Does it not make sense? Right? So these are the things that you want to know. Once again, these are the rules. So you want to play by the rules, right? So that's one thing about tax code. And like I said, all these things, they're not bad. You just have to know how they work. So you know exactly how to move forward when you position your money in a different tax bracket. And then we have a tax-free bucket. Great. So this is, like we say, the holy grail of wealth building, because a lot of people don't utilize these things. People don't even know these things exist. Roth IRAs and properly structured cash value policy is the only two vehicles where you can grow it tax deferred and access it tax free. So your money is growing tax deferred, just like a 401k. But when you're ready to access it, you can access it tax free, right? That's the best thing you could do. But that doesn't necessarily mean that you gotta put all your eggs in this basket and then hope for no. You still wanna diversify. You can diversify your tax structure, right? I'm always I'm always promoting, not promoting, but I'm always saying diversification is the best. No matter how good it sounds, don't put all your eggs in one basket and hope for the best. You want to put, a little bit here, a little bit there, but you just want to have an idea. You want to have a plan with it so that you know how to move forward, right? So when it comes to the Roth IRA, That is an account. It's also ruled by the government, obviously. And so with that, it comes with some rules and restrictions. And so one of the things is that if you make too much money, you can't even qualify for that thing. They don't want you to be great, obviously. So I don't know exactly the amount, but that's just a real quick Google search you could do. So you can look it up and see the amount. So if you're making then like if you're filing joint or filing single or whatever case might be, I think there's a difference in it. Then it depends on how much you make. So if you're making over a certain amount, you can't qualify for that. So they don't even want you to put in there. But if you qualify, now there is a limit on how much you could do on annually basis. I think if you are older than 55, you could do up to $8,000. Don't quote me on it. You can still look it up. If you are making, I think if you are younger than 55, you could do 7,500 annually or $7,000, something like that. So some people were like, oh shoot, I want to utilize this. I'm gonna maximize all, I'm gonna put all my money in there because I get to grow a tax deferred and I get to use a tax free. That's what I want. I'm not trying to share my money with nobody, right? And because of that, they're going to restrict you. They're going to be restricting you on how much you could put in there so that you're not just taking advantage. Because at the end of the day, they're not getting anything by it if you just keep doing that. They want you to utilize the other accounts, right? So that's why they're promoting those things. That's why you barely hear anything about these things. And then when it comes to that properly structured life insurance policies, this is properly structured is very important that you pay attention to. This is where you can put your money in there. This is not government structured, what is it, account. And so now finally you get to choose whatever you want. So you can put however much money inside in here. And then you also get to grow a tax deferred, like I said, and you also get to access it tax free. But you have to do it strategically and you have to know exactly how these vehicles also work for it to make sense for you, right? And so there are tax rules within these policies where it's going to show you like, okay, there are tax codes within these policies that show you how you can grow a tax free and why you are able to access it. Tax deferred and access it tax free. Great question. Can you move from a traditional IRA to a Roth 403B plan, pay taxes at a time of switching? That's a good question. Yes and no. The right answer is yes, technically. You can do that. However, just like you said, every time you take out money on it, like we always say, keep the tax buckets on its own so it doesn't create a bunch of tax what is it called? Problem for you, okay? And so let's just say, because I have a client currently I'm working with. He have $100,000 in his traditional IRA, okay? And so he wanted to put. We talked about these things, and he wanted to put his money inside of a tax deferred bucket, a cash value policy. And then I told him, because if you take that money out, one, there's two rules with that. One, if you are younger than 59 and a half, you're going to be penalized. And then with that, because you haven't paid taxes as of yet, you're going to be taxed. That's a whole bunch of money that's just going to go right to them that we don't need to create that, taxable event. And then on top of that, income taxes, because he's moving so much money, like $100,000 is a lot, then it's going to put him in a tax bracket that is higher than what his normally is, right? Because according to them, he's taking that money out. But luckily, he's over 59 and a half, so he's 60. So he doesn't, that penalty is at the window, but he will be taxed. And that, penalty, that tax bracket could put him in it super high. So we thinking, all right, we just want to pay the taxes now and then take our money. But that could create more problem than it could be some good to you. He might end up paying 30,000 on that, depending on what tax bracket he end up being, right? And then now out of the 100,000, he only have 70,000, which is kind of crazy, a lot of money, right? So things like that, you want to be strategic and you want to do it like systematically, maybe take a portion of it so you don't create a big taxable event for yourself, and so you don't have to pay a whole bunch of money. But the right answer is yes, but you just want to make sure that you know and you talk to your whether you CPA and different things like that. And then we can talk about it offline as well to see what some good options or whatnot. But the answer is yes, but be careful. You don't want to create a problem trying to fix another problem. What this problem be might be bigger than what you thought it was going to be, okay? Okay. They say you can withdraw from your life insurance when you are alive. I thought this was for beneficiaries. Oh, I'm glad you said that. It said 10%. I'm not sure what that 10% means, but yes, for that question or that statement, this is why we talk about it. Yes, life insurance, most of the time, it was known for death benefit. You're getting life insurance, you say, hey, I want to, God forbid, something happens to me tomorrow. I want to leave $100,000 for my family. How much is that going to cost me? The agents, write you a policy, tell you maybe, oh, it's going to cost you $150 a month. Perfect. You pay that. God forbid, when the time comes you pass away, your family get the 100,000. But life insurance is actually life when you're living. So it's not just for when you die. So life insurance can be used to pay off debt. To like my team and I, we help individuals and businesses to get out of debt, all of their debt, including a 30-year mortgage, within 9 years or less, using properly structured cash value policies. And not only are they getting out of debt, they're also building cash flow. So life insurance, properly cash value life insurance can be used to pay off debt, to pay down a mortgage, to pay for a car, college planning, business opportunities. And then with life insurance, there are also living benefits with it. If you, God forbid, if you develop any sickness, illnesses, anything like that, God forbid, if you qualify for it, then you get to use the death benefit, just like you mentioned, while you're still alive, because you happen to be, when you first got the policy, you was perfectly fine, and then 10 years later, God forbid, you maybe develop any type of sickness or illness, and now instead of you start depleting your bank account, your savings, and all these things, you can utilize that big death benefit to pay off for anything that you need to pay off for. So I'm glad you mentioned that. But yeah, life insurance is way more than just for when you die. There is actually living benefits. That's why a lot of people, the wealthy people, they utilize these policies to minimize the taxes, right? Because they can grow it tax free and earn high compounded interest. So they can earn high interest on these policies, grow a tax free, and access a tax free if you do it properly, if you know exactly how to do it. Is it, it's some tool, it's a mindset also shift, and it is, the other things of that you're doing. A lot of wealthy people utilize these things to minimize their taxes, like real estate. People have, instead of you taking your down payment from the bank and borrow from them or whatnot, you take your money from yourself and put it inside of a real estate. Your money is still sitting inside of the policy, growing for you, earning interest, and then you put the money right back in here. So I'm gonna talk about more, maybe another time where I'm gonna get invited back and we can, dig deeper into all of that. But yes, life insurance definitely could be used while you're still alive. There's so much opportunity, so much potential with it. So it's not just for your family. You can actually use it for yourself with life insurance. So I'm not sure what that 10%, Mona, you were
Yeah,
saying.
it's the 10% is for the 401k if you remove it if you're earlier than
59 and a
59.
half? Yes,
Yes.
correct. That is correct. Yes, ma'am. So, yep. If you don't want to be right, if you don't want to be penalized, you want to make sure that you want to have a strategy so it doesn't create a problem for you. And then, because those things that you got to make sure that it is good so that you won't create any type of problems for yourself. But yeah, great questions. No, it does not apply to term policy because term policy, they don't build cash value. So these only apply for, let me go back. These only apply for cash value policies. That could be whole life policy, universal life policy, indexed universal life policy. Because term policies, it's just like it sounds like, it's temporary. After the term is up, majority of the time, people who get term policies with other companies, like the known companies, if you will, that term is up. So if I get a term policy for 30 years, for example, after the 30 year, now I got to find a new policy. But the companies nowadays, they are offering policies where after the 30 years is up, you can actually convert some of that money to be permanent. So term policy don't necessarily build cash value, so you can do that with that. So that is a good question. Say more about that. Yes, absolutely. So the question is here, I heard that if you borrow against it, you pay it back with interest. Can you say more about that? Yes. So let's talk about it. Life insurance, the cash value life insurance, works a little bit, you could see it as like a savings account, if you will. So, or like a bank, yeah, savings account with your bank. If you put, let's just say, I did a policy, the thing about it, okay, let me just go back. The thing about when you get cash value policies is that you don't want to say, what is the minimum I could do? Your whole goal is, what's the max I could do based on my financial situation? So my financial situation may be, however much I earn or whatnot, I can afford to do $500 a month, right? But somebody else's, the max they could do might be $150. So that's just, just to having the mindset, like, once again, you don't want to say, what's the least I could do? Because then you're not necessarily helping build the cash value. Because the way life insurance work is that, just like I said, if you're looking into the death benefit, you're paying that small amount of death benefits. Okay, you apply for $100,000. The agent might tell you it's going to cost you 150. Perfect. You pay that 150 for that $100,000 death benefit. So that 150, we call that the cost of insurance. The cost of insurance for you is $150 a month for that $100,000 death benefit, right? That goes with the fees, paying the agent, all that good stuff, right? Boom. It's a contract. When you pass away, your family receive that. When you're looking into the cash value policy, now you want to look into what's the max I could do comfortably for myself. If you say now $500 a month, now a small portion of that 500 will go to pay for the death benefit, the fees, everything that I just gave an example of. A big portion of that 500 will now go towards the cash value. So it's like almost two different buckets. It's not just the death benefit focus right now. We have a cash value we want to build. That's where you are going to earn interest. And that's also where you are going to be able to accumulate and earn interest and grow it and start accessing it. And then, so for that question, let's just say now you've been able to grow your cash value for $20,000. And then you say, oh, I have a really good business opportunity. I want to take $10,000 out of there. When you take out that $10,000, your account is still going to show $20,000 like you've never touched it. And the reason why is because the insurance company will be the one lending you the money. So they say, okay, you want to take out 10,000? Perfect. We're going to give you 10,000. We're going to leave your 10,000 still in there to earn interest, to continue to grow for you like you never touched it. And we're going to use that as a collateral just in case you don't put that 10,000 back, right? And every time you borrow money, just like we borrow money from anywhere, even the banks, right? There's some interest that comes with it. However, the interest here is way lower than it is with the bank. If you go to the bank and want to borrow $10,000, now that might be, 10% interest, 15% interest or whatnot. Usually with this insurance companies, the interest is about 5%. I have not seen it going 5, maybe 5.5 if anything, but that's just kind of high. But usually it's between like 3 to 4, 5, I would say. It really depends on the company as well. And so now taking that $10,000, you do your business opportunity, you have the mindset, okay, that money is going to make me more money, right? And you do your thing, and that money is making you more money while your money is sitting over here and still growing for you. So if you think about it, that same dollar is making you more dollars, right? You earning interest over here like it's never been touched, and then you're still doing business with that same dollar over here, right? And so when you pay it back, Now you're going to continue to grow your policy, and you don't have an outstanding balance, right? And the only thing that can happen with that outstanding balance is, God forbid, you pass away without paying that balance, because the insurance company used that money as a collateral. When they pay out that death benefit to your family, they're just going to deduct that outstanding balance, and then the interest and stuff that comes with it, and then your family will receive the rest of the money that is inside of death benefit. So with that, your death benefit might be $100,000 or $200,000. So they're going to deduct the $10,000 outstanding, and then the interest, any fees with that, and then the rest of the money will be delivered to your family. So with these policies, there is no like payment schedule. They're not going to tell you, oh, what are you going to use that money for? Apply a whole bunch of things, or you have to have a good credit. No, this is your money. You get to do whatever you want to. And compared to the bank, you have to qualify, you have to have good credit, you have to have this and that. And when you take money from them, one is super high interest, right? Two, your money is not working for you two places, right? And this is what we also call leverage. You can leverage life insurance policies to do business, to grow your assets, to plan for retirement, pay for college, different things like that. So I hope I answered that question. It was kind of long, but I want to make sure that you understand. Did that make sense? Yes. Okay, perfect. I love that. And then it says, is this an IUL Index Universal Life Policy? Yes, ma'am. So it is Index Universal Life Policy, and then also whole life policy. So the Index Universal, the difference between those two, just quickly. If you guys really want to, more information, more in depth, you guys can, request, and I can come back and explain more. But with the whole life policy, the difference between those two is whole life, it give you that fixed interest. So no matter what the market is doing, you're going to get that fixed interest. So that might be like 3%, 4%. The market goes up, down, left, right, you're going to get that interest, right? And then on top of that, most companies offer dividends. It's not guaranteed, but the companies I work with, they offer dividends. They've been paying off dividends for over 100 years. And then so that's going to help you grow your money. And so we utilize whole life policies actually to help individuals to get out of debt and it be more guaranteed. If you follow the plan we give you to pay off your debt, it's going to be guaranteed, that you get out of debt within a certain amount of years that you thought didn't even think it was possible. Like I said, 30-year mortgage within 9 years or less. That's huge, right? And so you do that, you'll be able to do that utilizing these policies, and whole life policy, because it got that guarantee, you could do that. While the index universal life policy, that's more so of you have a zero floor protection and upside gain. So you get to participate in market gain. So maybe you are able to earn 8% one given month, maybe 9% another given year. And then month, it's a year, it's an annual interest. And then maybe another year, maybe 2%. So it can fluctuate. But if the market goes down below zero, you don't lose anything. You stay at zero. You don't earn it. Your policy won't be credited anything. But at least you're not losing anything. You're not going on the roller coaster of the market. So you have more potential of, accumulating and earning higher interest while you have with the whole life policy. But it really depends on what options you go for, depends on what you're looking for. Why are you getting the policy? Is it for retirement? Is it for business? Is it for college planning? Is it to pay off debt? Different things like that. And these are questions that we ask to make sure that we understand the client and then see which would be the best option for them. Yes. Yep. Perfect. Is this circle?
Yes, the link is Circle. The join the community link is on Circle.
Perfect. I think I just got it, and I'm trying to figure out and navigate through it, but I'm gonna learn because I did see it and I said, oh, this is awesome. I see so many people active and stuff like that. Yes, so definitely if you guys want to chat more and have more questions, whatnot, we can take it offline. But yeah, so actually about to end the conclusion of it. So your next step to financial freedom, so a couple things that you want to look into or think about is review which bucket your money is currently sits in, right? You want to understand these different buckets, review it. Okay, where am I placing my money? And am I competing with inflation? Is my money going downhill or is it going up? You know what I'm saying? And stuff like that. So you want to look into that. What is the goal of this money? You know, I have a savings account, but what is that? Is that just for emergency? Is that for, you know, a down payment for a house for 2 years from now? Is that for a car payment? Different things like that. And based on that, it'll give you an idea where you should place your money so you know to maximize it as the best of you can. So you won't just, you know, the money is just not a whole bunch of holes in that bucket, right? And you're losing it unnecessarily or unwillingly without you, you know, having the knowledge. And then the next step is also calculate how much monthly cash flow you have that you can free up by accelerating your debt payoff. Like I said, a lot of people make a lot of money and then they go back and think like, where's my money going? Right? I'm making $100,000 a year and I don't have anything to myself because I'm paying all these bills. So we're not. Maybe this debt that's holding you back, right? A whole bunch of things. So a whole bunch of money going, interest and all that going to the lenders because you're paying all that debt. So you want to see how can you free up debt as much as possible. So majority of the money that you are giving away, you can keep it in your pockets. Okay. And then like I said, once you do that, you know, it's a domino effect. Now you can redirect the freed up money into Roth IRAs, properly structured cash value policies, different tax vehicle advantages, because the other ones, a lot of people already know about it, right? So, like I said, don't put all your eggs in one basket. If you are able to diversify, it's the best thing ever. But just understand the rules, and so you know how to play by them, right? And then ensure adequate life insurance coverage. I just had to put this in there because September is the Life Insurance Awareness Month. I don't know if you guys knew that. And having life insurance, whether that be for cash value insurance or whether don't even, you know, not even that part about it, just having life insurance in general is really good for you, for yourself, because God forbid if you get sick, injured, anything, and you are the breadwinner for yourself or maybe for your family or maybe you're contributing to that, all that stops. You can rely on, you know, what is it called? The pay from the company and whatnot. But that don't last long. Your bills still gotta get paid, all these things, right? Having life insurance will give you security for yourself because that could be an income replacement while you out. So one thing I'm gonna leave you guys with is that we don't want to talk about these things, but people, you know, people pass away. Either you get sick and you pass away, or you get or you just, you know, or you get sick and you get better. If you get sick and you pass away, God forbid, what are you going to leave to your family? Are you going to leave wealth or are you going to leave debt? Or is it, you know, nothing? But if you get sick and you get better, during that period of time and you get sick and you are trying to get better, that's when a lot of people accumulate a lot of debt because you already guys know how expensive it is to get sick in the US. The medical bills here is serious, 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 right? And so that is not none of us want to wish that upon ourselves, our families, none of that. But these are the things we got to talk about. Anything can happen any given day. God forbid if it ever happened to us. Tomorrow's not promised. This afternoon is not promised to us. But just having something in place will give us a little bit of peace of mind, knowing, okay, if something happens, I have something I can bounce back on. Income replacement that's going to help me to get through the season. And then, you know, God is going to take care of the rest. So that's all I have for you guys. When you know better, you do better. When you know the rules of the game, you know how to play it. So that's it. If you guys have any questions, I know we're running out of time. We can connect on Circle. I'm trying to figure that out as well. But yeah, that's it. I hope this was very helpful and informative. But that's it. Thank you guys for interacting as well. Appreciate that.
Thank you so much, Melat. This was definitely it was great. Um, how can they, is that your information? Yes. How can they contact you? Do you have your website or
Oh,
that's
I
your
wasn't sure.
LinkedIn?
I was, you know, when you gave me this, or I don't, your team gave me this template, I wasn't sure
Yeah.
if I was allowed to put my information out here.
Yeah.
So
So
I
you
just
can
kept
put
it.
yours in the chat if just in
Okay, I
case.
could definitely do that. Yes.
Yeah. So anyone who wants to contact you or has any questions right away, yes, we want them to be on Circle, but you might also like Circle it's a platform you're still learning to navigate. So in case anybody wants to reach out to you, they can. Um, All right. Thank you so much for really being generous with all this information. You can tell people had a lot of questions, and we're definitely going to have you come back and maybe spend more time on each of the buckets.
For sure.
And that will be, I think that will be good for us as well. Um,
Absolutely.
That'll be good for us as well. Please, for everyone, the replay of this will go live on Tuesday. Uh, and so please look out for the email that will let you know when this goes live so you can watch it again, share it with your friends and family and all of that. And, share with everybody who needs to hear it. We are posting our replays for our masterclass series on YouTube now. So please go to the African Immigrant Collective on YouTube and subscribe. That will help us continue to drive the message around. I've put a few announcements in the chat. Join Circle. That's where all the dance is. That's our community home online for now. So please click on the first link to join Circle and be a part of the conversation. Invite people to join Circle as well. And then we do have a few things in the pipeline coming up, but the most important one that we have pending is October 25th. It's our advocacy conference. It's the first one ever. With the climate of the day, it's important we know what the policies around immigration and around how we just live are, and how to advocate for ourselves. And so that's what we'll be focusing on October 25th. It's going to be a hybrid. So if you're in Atlanta, we are going to be local here. We're finalizing with Georgia Tech, but we will be at Georgia Tech University for the event. And for those who are not local, you can join from anywhere. It's going to be hybrid. So please go ahead and sign up today. The link is in the chat. I want everybody to take some time to, it's going to take you a few minutes to sign up, but go ahead and click on that link, the very last link I shared, and go ahead and sign up for this. If you do want to volunteer with AIM, there's a link to volunteer as well. Everyone who comes here as an expert, as a knowledge partner, or does one thing, everybody serving within AIM it's a volunteer. If you feel like you can bring value in one area or the other, it's for us by us. So please find a way to get plugged in, to get involved. And if you want to donate, maybe you don't have the time, but you have the resources. There's also a link to donate. We are a 501c3 organization, so every contribution or donation you make is tax deductible. So we urge you to donate to us to keep the work going. We need to reach more people. We need to serve our community. A lot of people needed to hear this thing today, but our promotion budget is limited. So we need everyone to chip in. Let's continue to build together. But we do this every Saturday. Next week Saturday we're not having a session, but every Saturday we do have a session like this. And so please stay connected to everything going on. And I think that's all the announcements I have. Thank you again so much, Melat, for this session. Thank you everyone who joined. And we'll see you all during the next session. God bless you all. Enjoy the rest of your day.
Yeah, thank you guys so much. You guys have a blessed weekend. And yeah, let's connect, let's chat, and let's build this thing and help each other. I'm super excited to be a part of this and continue to learn from you all. So I'm happy. Thank you for having me.
Thank you. Thanks. No worries. You're welcome.
Bye, everyone.
Thank